what's going to be the effect of AI into this little part of the world?
Let me check my generative AI app on my phone to answer that one. No, but in all seriousness, yeah, I mean, AI is here. It's
Hello, welcome back to the ERM Advantage podcast. I'm Eric Holmquist. Today, I'm very excited to have in studio a longtime friend and colleague, Mr. Brian Velligan. Brian is, like me, a long-timer in the financial services industry, been in it for over 35 years as well. And about 20 years ago, he co-founded, along with his partner, Hugh Blaxall, Velligan-Blaxall Consulting, and based in the Philadelphia area. And they do work for institutions ranging from de novos to money center banks, with a particular focus in kind of the financial risk areas, including model risk management, asset liability work, liquidity modeling, stress testing, and behavioral econometric models, which you can explain what the heck that is. And what I love about from our conversations and what, where you guys really focus is it just really aligns with what I'm kind of talking about helping find tools to help management make better decisions, which I think is pretty central to what you guys do. So, Brian, welcome. I'm so glad to have you today.
Well, thank you very much, Eric. It's my pleasure to be here.
So we're going to talk about a variety of things, and we're going to cover some topics sort of all around the data analytic model world, and we'll cover a whole bunch of different things. But I want to really spend a lot of time talking about analytics and something that I know not just every institution, but every company does a lot of modeling analytics, and it's obviously it's sort of tangential to where my work has been focused in risk management, but you guys really get into some of the weeds of some of that. So I really want to kind of pick your brain and learn from you about some of the deeper truths about modeling and analytics. So we're going to start in that space, modeling, analytics, data, technology, and then we'll kind of move to more around the model risk area and validations and all that good stuff. So let's, start 10,000 feet. Again, you work with a variety of institutions. Maybe you could kind of just, kind of give me some of the key areas where, you see institutions utilizing modeling and analytics and in what ways.
Sure. Well, as one can imagine, modeling and analytics are instrumental in making key and informative and productive business decisions. So I think of my career over the last 35 years and how that's really changed where, especially at the community bank level where you might have a second or third generation owner has used basically intuition, to make decisions, business decisions. And that's changed dramatically over the last 35 years where people are relying more and more on analytical tools and models to inform decisions and to a certain extent even rely upon them, which has certain risks because they're just assuming the models are right.
Yep. Yeah, and it's funny. We were talking about this earlier. We go back far enough to know when we had Lotus 123 dropped on our desk and they'll figure out how to use this. And man, we're a long way from the nonsense that we put together. Although I do say, I think I built some pretty decent analytics in Lotus and Excel, but like I said, I couldn't touch what we're doing. Do you generally find institutions tend to structure their analytics programs around regulatory expectations, or more around just best practices, or what?
Yeah, I mean, that's a great question. And generally speaking, it's really more around regulatory expectations. I mean, it really is interesting because if you think about how the expectations have sort of matured over the years. I mean, we go back, say 26 years to 2000 when I think the OCC came out with some guidance on model validation. And that was really the first, thing that I'm aware of where it was actually formally articulated in some form of guidance in 2000. And when you look at that guidance, it really talks about using a validation process, almost like an audit, to critically challenge the results of the models, and and that really in that era, a lot of it really seemed to be more like benchmarking, running parallel models, champion challenger models, just to sort of see, can I use a different tool to get the same answer?
Yeah, and again, you've seen all forms of modeling and analytics, and we'll unpack some specifics, but for an institution, again, that really wants to use tools that tell them something, and as I said, serve as a business decisioning tool. What would you say are some of the most important areas of modeled analytics, for a company to be using?
Yeah. So when you think that through, I mean, in my mind, I really think of three key pillars, if you will, where modeling comes into play at financial institutions and industries such as that. And that really is financial risk models, which are really models that ultimately would roll up to, say, a CFO. Then you have credit risk models, which might, provide data that rolls up to a chief credit or chief lending officer. And then finally, you have the compliance models, which really help institutions conform with the alphabet soup of regulations that financial institutions must follow. And of course, those models would roll up to a chief compliance officer.
Right. And I'm going to sort of poke at this from a bunch of different directions, and just to try and sort of understand, because again, I've seen a lot of different activities, but sometimes I question: are you just doing that to check a box, or are you really actually trying to learn something? So, looking to the opportunistic side again, because you've seen every form of analytic tool, are there any kind of sort of modeling or analytics that you sometimes don't see that you're kind of surprised? I'm sort of surprised they're not doing that can really be a valuable tool.
Yeah, I'll have to think about that for a minute. But what immediately comes to mind is when we think of the compliance model. So one key example that would be like the anti-money laundering model that a BSA officer would use.
Yeah.
And we call that a rules-based model because it's basically looking for patterns in data. And those models, that primarily was done by a BSA officer and their team, and it was a manual process. They would arbitrarily pick transactions, they would go through them, and they would look for patterns manually. So while I think pretty much everybody this day and age is using some type of an AML model, the truth of the matter was just even 4 or 5 years ago, there were several community banks that were still doing that on a manual basis. So I would say that these compliance models are probably the most recent additions, to the modeling family.
Yeah, and one in particular that comes to mind, and it's a subset of the analytic world, but I'm often surprised I don't see more institutions doing good profitability analysis. And it seems like sometimes it's a data issue. We just don't have the data. But I don't know. I feel like that's really useful information. Is that something you see commonly or not?
Well, it's funny you say that, Eric. Actually, when I started my career in 1991, one of the first things that I did was develop a profitability model using software tools in a database called FoxPro. And for the institution I was working with at that time, that was just it. We started off looking at profitability at the line of business level, and then ultimately at the branch level. We didn't get to the product level. But profitability is surprisingly challenging because there are so many indirect costs. You've got the accounting department, you got the CEO's salary, and things like that. So there's a tremendous amount of energy that goes into profitability models around allocating cost accounting, indirect costs, and things like that. So I think for that very reason, a lot of institutions tend to stray away from profitability models, but they are absolutely critical because at the end of the day, you do need to understand where the revenue is coming from.
I've had this conversation with a handful of folks, and I guess because I hear that a lot. Like I said, we don't have good allocation models, but again, we're not looking for super precision here. Really understand what's basically profitable, even if some of it has to be a little back of the envelope. To me, it doesn't seem like a reason not to do it. Just recognizing you're only doing it with a certain amount of precision.
Well, that's a great point. And I think that really is something that often falls on deaf ears is that when you think about it, when you have an accounting system, for example, you expect and demand that your accounting system is 100% accurate.
Right.
You want those numbers to be spot on. They're historical costs. They're easy to measure. They're quantifiable. And that you're aiming for a 98 plus% accuracy. However, with profitability models, there's a forecasting element, and it depends on if you're looking at historical performance and looking at how did these different business lines perform over the last year or two, or if you're forward-looking.
Right,
and that's the real key difference there, because if you got I don't know about you guys, but if I had a stock picker model that was 75 or 80% accurate, I would be sitting here right now. I'd be on a beach somewhere in a much, much more favorable climate.
And it's so funny you say that, because I keep stumbling upon videos to say, our AI tool, give it $20 and you'll be a millionaire and it'll do all it for you. And there's an old saying, when something's too good to be true, but we'll talk about AI. Generally speaking, do you see, when it comes to sort of, again, analytic capabilities, do you see more institutions building that capability in-house or outsourcing or co-sourcing or some combination?
Well, I think the answer to that depends on how much of it is a model and how much of it is a process. So, for example, if you think about interest rate risk modeling, which is part of the asset liability process, you're going to see smaller institutions will often outsource that to a third party, which is something I did earlier in my career myself, and something that our firm currently does offer as a service. And the reason why is because there's an expertise around the process. Because often what happens with these models is, for those who are listening that studied accounting as I did in college, there's a breakdown between relevance and reliability, and they're matching one with the other. So for the data to be relevant, that means you need to get it quickly. For it to be reliable, that means you have to scrutinize it and test it and everything like that, which means it may no longer be relevant by the time it's reliable. So at the end of the day, a lot of institutions spend so much time building out these results that they don't really have an opportunity to actually analyze the data. So it's kind of like, what does this mean? What do I do with it? So what?
Yeah.
And that's what's often missing. So that's where it comes down to, if you're in a situation where you don't have the resources to do that second part of the equation, which is the so what, answer the so what question, then you probably need to outsource it.
Yeah, and it's fun. I realize there's no one size fits all.
Mm-hmm.
Okay, and every institution is going to have unique circumstances. When you're small, you don't have any bodies.
Right.
Everybody's doing 3 jobs. So having a hardcore analyst is probably a nice to have for a while. And then you get to a point where you start building out some depth in your kind of finance analytic bench. And so there's probably a necessity, going in, you probably have to use, some external resources. But kind of what I'm hearing is, even at the point when you develop your own internal resources, there's probably some merit also having external resources that can amend, can challenge, can do that. Because one of the things I see, I don't know, and this is a problem that for institutions that outsource a lot of their modeling analytics, or a basic kind of an ALM model, is, I don't know, I may be wrong, but it seems like they get the data back and they look at it and go, okay, that looks good, and in the drawer. But if you want to, challenge and dig deeper, do I have to go back to my third party to do that? So it sounds like getting to an equilibrium of internal resources combined with some external resources is kind of an optimal model in a way.
That's right. That's a great point. And I've sat in both those chairs. I've sat in the chair where I'm actually producing the data, doing what they call that first line. And then I've also sat in the second line chair, which is what I do more today. And that is where you're actually critically challenging the results to make sure they make sense. So, at the end of the day, one of the biggest challenges that we see with outsourcing is that an institution makes, an educated decision to engage with a particular outsourcing party, and they perceive that party to be an expert in the field in which they're outsourcing the models to. The problem is that the institution then relies on that third party's expertise to actually help inform the assumptions in the model, to help kind of like, what do we do with the results and things like that. But the most important thing that the regulators demand, and is just honestly industry best practice, and if I were a shareholder or a board member or a bank, I would demand it, and that is that the institution itself has to own the model. They have to own the results. They can't outsource that responsibility to a third party.
Yeah, and that makes sense. Yeah. This is sort of on the spot a little bit, but are there any resources out there? It could be, forums, peer groups, knowledge forums, data sources that people should just know about, that you guys say, hey, this is a really valuable resource that institutions could use.
Well, I mean, it's a that's a pretty broad answer to that question because, again, when you think about the different types of models that are out there today, it depends on what is the ultimate purpose of the model. So, for example, since we were talking about asset liability modeling, which is where I started my career, you think of things like the FRED data, that comes out of, so that's economic data that is free that anybody can download, and it's referenceable and it's accurate, and you get yield curves and basically historical market-based assumptions.
Right.
So that's a good tool.
Yeah.
And then you think about, okay, well, with credit decisioning models, it's like, okay, well, then I probably need some kind of empirical evidence or information such as like FICO score for consumer lending or property values or appraisals and things like that. So really, to answer the question is challenging because it really depends on what kind of model you're talking about.
Absolutely. And sometimes there's like things in people's back pocket that go, God, everybody should be using this source. Not to supplant my expert resources I have, but where data is available. And we're going to talk a bit here about data. And this is as you well know, it's a topic I'm pretty passionate about. And I've said for some time that I think institutions have to be able to use and leverage their data. And I'm often surprised how little institutions do. And it comes down to a number of things. We're going to unpack a couple of layers of this. But again, I like being challenged. I throw out provocative sayings. I'm always welcome for my expert, friends and colleagues to challenge. But would you say that it's a fair statement that having the ability to fully leverage your data is a real strategic advantage versus not being able to use it? It could really differentiate a superior performing institution versus just an average performing institution.
Well, I would actually go the other direction. I would say if you don't have good command and have high confidence in the quality and integrity of your data, then you really have no business being in business. I mean, at the end of the day, the data is everything. So, I mean, that is, and that's usually what we see. When we see models with funky results, it's usually either some kind of mapping misalignment or it's the quality or the lack thereof of quality data.
Right.
And data is what you have. I mean, if that's your most valuable asset.
And let's talk about the quality issue. And every time I venture into the data quality area, I cringe. And the reason I cringe is we've been talking about this for decades, and we have data quality issues. And I keep saying it's like saying the idea of the paperless office is a myth. It's never actually going to happen. I said, are we ever going to not be talking about data quality issues? Because he seems like every time we talk about, how could the institution leverage their data better, it always comes back to, well, the problem is we have data quality issues. So, I mean, again, are we ever going to really solve for this?
Well, we must. I mean, we must as an industry. We have to do better because data is the key to success. Without data, you can't make accurate. You can't tell where you've been, and you can't actually analyze if you're headed in the right direction to where you think you want to go. And so that's exactly it. I mean, we talk about, us as an economy, 200 years ago, we were an industrial economy. Now we're an information economy, I think is a term that's used often today. Right. And that's just it. Information. What is information? Information is a culmination of data or data. So if you don't have the data, you're just not going to succeed.
Yeah, and so that's more pet peeve territory than anything. Let's be constructive and talk about the stuff we can control, because I think that's just going to be something that's going to dog us for a long time. But then we look at, again, the structural elements, the things that we really could control is, do I know where my data is? Do I understand how it interrelates? Do I know how I can use it? Do you see the industry getting better at this? Are most institutions using some sort of a data warehouse or a data lake that can become a central tool that they can actually use? Or are we still heading with that as the goal?
No, I think directionally, I think it's getting a lot better. I mean, I think institutions intuitively understand the value of the data that they have. And let's face it, storing data is a lot cheaper than it used to be. I mean, so you can get a terabyte hard drive, and throw it in a laptop. I mean, for a couple $100. So I mean, I mean that volume of data 20 years ago, would have cost tens of thousands of dollars. So I mean, the ability to store data is becoming a lot cheaper. The challenging today that I think we face is not storing the data and collating the data; it's protecting the data.
Yeah, yeah, and I there's a couple of different ways that we'll again sort of dance around this, and I've talked to a number of colleagues and clients that they describe their data as a journey. So we're on a journey to not just for data quality, but getting it all centralized, understanding it. Do we know where it is? Do we know how it interrelates? Do we know how we can use it? And that's fine, but to me, this can't be a leisurely stroll. To me, this is something that's worth really prioritizing, sooner than later. I mean, is that fair?
That's absolutely fair. I mean, and again, I don't want to feel like we're beating a dead horse, but without having quality data in which to make informed decisions upon, I mean, you're dead in the water. Because if you don't have it, I can guarantee you your peers and competitors do for their institutions.
Yeah, and there's all the tangential pieces. There's you provided this report, and do you know what was the lineage of the data and where it came from, and how many machinations it went through before it landed in that report? And I've really pushed for that sort of stuff. And beyond the internal data, do you see more institutions utilizing external data sources, and if so, how?
Well, yeah, I mean, external data sources are usually a key place to go for assumptions. So when you think about model inputs, you've got your institutional data, you've got your own internal data, your loan details, your general ledger details, your transactions around deposits, whatever. And then you've got what I would consider more market-based data, which might be prepayment speeds, market interest rates, things that are outside of the institution's purview. And so those routinely are usually extracted from an external source, some type of a data company. And it also depends on whether it's readily available information like a treasury yield curve. You can get that anywhere. You can Google it and get it anywhere. But FICO scores, for example, which I referenced earlier, I mean that's customer specific. It's kind of privileged. You got to pay for that. It's got to be tracked. Things like that. So, but it is true. You've got your institution specific data. You've got the data that usually drives the assumptions, and those are usually the two major key inputs into any kind of model.
Yeah, yeah. And I have to ask about this because I've said many times, one of my new favorite positions is the chief data officer. I just think it's a fabulous position. And not everybody agrees. But I just think at some point, having kind of a steward over both the governance of the data and making sure there's some structure around how we manage it. Is that a position that you see more? And do you feel that is a position that can create value?
I do see it more, and I absolutely agree that it's a position that can create value. Because again, we have the tools and the techniques, and that's what I think you and I have seen over our professional careers is that real transition to where data is much more accessible.
Yeah.
And it's really foundational in making decisions.
Yeah, and it would be helpful just to look at one aspect because what we don't want is kind of the data cop. I think there's an equilibrium between someone who can bring some structure around controlling access to data, but you also don't want this to be this grand fortress you have to penetrate to get to it. So there's a sort of a quasi-control element, but at the end, I think their job is also enabling the business by getting data that's can be available. So, any thoughts on how to think about that person in that position that could be successful to sort of have a foot in each area, sort of a controller, but also an enabler?
That's a great question. And I think that it is important to have some parameters and a framework in which is what's considered a minimum data standard. So, for example, when I think back on my career, back in the early to mid-1990s, I worked for a community bank. And the bank I worked for was heavily involved in buying loan pools from the Resolution Trust Corporation, or the RTC. So we were buying these pools of loans, and once in a while we get a data tape, but usually actually got files. And of course, there was that push-pull once again because the institution wanted to get those data files into the core, so therefore they could send out modification letters or whatever needed to be done. And what we found was that the quality of the information that was being input into the systems was really, really suspect. And we were making mistakes. We would call new customers, effectively new borrowers, with questions, and the information wouldn't be correct, and we wouldn't be managing it properly. So I do think that I would not want to think of a CDO as a data cop, but I would also think that it is important for an institution to have minimum standards of quality data, because that gets back to your earlier point of how can you make effective business decisions if you don't have the data to do so.
Well, that's definitely something I've seen is sort of a focus on keeping data from continually replicating, and ending up in share drives, and because as you said, protecting it is paramount. We have to be able to. And then the challenge is, are we using it in the best possible way and leveraging as much as we can? When you've seen a chief data officer, where do you typically see that role reside within the organization?
Yeah, so usually it seems to kind of fit in with the IT space, kind of in that area. Somebody who's working closely with the core, because I guess at the end of the day, you kind of think as the core is really the system of record. That's the primary data source. That is the file room in which data sits. So usually it's somebody who's either as part of what I would consider the IT function or sits adjacent to that.
Yeah, that's what I see as well. Mm-hmm. Yeah, and I like that because, like I said, I want them kind of where the data is.
Well, that's just it. Because you think about it. What the chief data officer, their role is kind of a first line role. So you don't really want them as an element of compliance or risk or something like that, because the risk and compliance are challenge roles. They're not they're not responsible for the data.
And I agree. And I've seen at least one instance where they were in risk, and I thought, look, I love risk management. I'm a big fan of people in risk management, but that to me felt they were seeing it as an oversight role, but like I said, he kind of needs to be in the trenches.
That's right.
And so to me that felt slightly problematic. Again, no right, no wrong, but everything's a dog with different fleas.
That's right.
So I want to pivot just slightly. Again, we've beat on data a bit, and I could beat on data all day long because again, it to me it's such a strategic element that people still wrestle with. But let's flip to more technology more broadly. Again, there's a lot of analog tools out there, and anybody who knows me knows I hate all technology equally. But again, you've seen the good, the bad, the ugly. Are there any tools out there for the data and analytic world that you think are particularly good, or you've seen particularly effective clients use?
Yeah, again, it kind of depends on what the ultimate type of data that's being analyzed. But I know one tool that I have my team lean into pretty heavily is actually a software that's called Alteryx, and Alteryx is it's sort of used as a data aggregation tool, and a lot of models today are aggregation models. Even if you go all the way back to DFAST and CCAR, effectively they're aggregators or enterprise-wide stress testing models. Usually it's usually data pulled from a number of different sources that's kind of crammed together to sort of create a specific scenario. So Alteryx is one that we kind of see on the front line that seems to be quite powerful and useful. Now, with it, there's a certain amount of risk because obviously you want to make sure you understand exactly how the data is being put together, and that needs to be independently reviewed. But it is a great data massaging tool, I guess, for lack of a better word. And then on the second line, another tool that we use, we use Oak, and I honestly, exactly what that stands for escapes me, but it's an analysis tool that's really helpful because we still have a number of institutions that use what I call spreadsheet-based models. They basically use Excel. They'll have a 20-tab Excel spreadsheet that effectively they call a model. And with a tool like Oak, that will actually tear the whole thing down. It'll go in and it'll show you how many hidden tabs there are, how many distinct formulas there are there formulas that are actually going to a dead space and things like that, because spreadsheet models are extremely dangerous, and I say that I mean that there's a lot of there just isn't really any control in place. I mean, you can lock it down, you can lock fields and things like that, but you insert a row or a column. We've all made that mistake before, or resort something, and and bluntly putting it, all hell breaks loose.
Yeah, I said that the spreadsheet, in many ways, is the best thing and the worst thing that ever happened to us, and again, we could go down that path. For institutions that you see implementing, technology, what have you seen as kind of success factors, when implementing, analytic, technology that really helped to ensure success and getting what they wanted out of it?
Well, I think really it's going into it knowing exactly what you do want.
Yeah.
A lot of times people will say, well, I want a tool to help me detect fraud, or I want a tool that helps me understand what my interest rate risk is. Well, do you understand what that means in the context of your organization? So I think at the end of the day, having a plan and exactly where you want to be, what the end of the road looks like. I think a lot of people are easily swayed into slick sales tactics that might be used by various software vendors.
Slick demos,
yep. Things like that. But at the end of the day, knowing what you want and sticking to it, because that you need to know where you want to wind up.
I've seen so many failed attempts and software on the graveyard pile where they bought the slick demo that all you have to do is click here, 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 and everything will be provided. It never works that way. We were talking about this recently with like GRC tools and things. I think one of the most dangerous things you can do is we don't have a program, or we don't have a process, so we'll buy technology, and that will fix it all. And in my experience, that just makes it worse.
That is really, really important. I mean, one of the main reasons why I see a software implementation fail is because the institution is unwilling to commit the resources to see it over the finish line.
Yep.
So any software company is going to come in, they're going to sell you the software. They generally will give you the bare bones minimum to get it implemented. The 16 fields out of the 32 possible to get it mapped, and then they disappear. They don't understand the art behind setting these models up. And then institutions, they've met the budget because they budget for, well, what's the software company charging us? Okay, well, that's the budget.
Right.
And it's like, well, no, you probably need to think about maybe nearly double that number, because then it's like after the software is in place, it's all the tweaking and modifications and adjustments and I didn't think about that, or all those kind of things. So it's really having the determination to see it through and really put in the budget to make sure the model is really thoroughly and properly implemented.
Yeah, and I guess this is true with just about any implementation. Again, what are you trying to solve?
That's right.
And is this the best tool? Both for what we're trying to achieve is, again, do we have the resources? Do we have the expertise and all of that? The deadly question I have to ask, and again, for whatever we can cover on it, is we have to ask about AI. So how do you see AI influencing the modeling and analytic world? Maybe near term and long term. What's going to be the effect of AI into this little part of the world?
Let me check my generative AI app on my phone to answer that one. No, but in all seriousness, yeah. I mean, AI is here. It's maturing at a rate that I think we really fail to grasp as a society. I mean, I'm not talking about Terminator stuff here. What I mean is, in a very practical sense. I mean, I am shocked at how much AI has changed since the fall. I mean, in terms of how it's developed and the accuracy in it and everything like that. But again, AI is a tool. So at the end of the day, you can fear it, you can run away from it, you can deny its existence, or you can embrace it and understand how it is going to be informative and transformative in the future.
Yeah, and the conversation I've had with a whole bunch of my colleagues and clients and all that is a fair amount of we'll see.
Yeah.
I've said to you, and I said it in an earlier podcast, I don't really fear the Skynet scenario. I don't fear necessarily loss of control, but I do fear loss of quality, and I have to imagine that's a central concern in the analytic world because we kind of need to know the data's right.
Key point. I mean, relying upon AI to guide your strategy and your decision making is a race to mediocrity. I mean, at the end of the day, you're still going to need the human in the loop, the human element to come in and really understand. Well, this is a great AI answer. This is great code or whatever you use AI to generate for you. But at the end of the day, does it really fit the culture, the context, the purpose of why my institution exists? And what's really, I think, going to be challenging is there's going to be this middle ground where you're going to need people who have experience to be able to critically challenge AI. People with a certain amount of gray hair, such as myself. But on the flip side, how are the people who are just graduating from school now? How are those people going to be able to develop those skills to challenge AI? That needs to be answered still.
Yeah, and I've taken a, I don't know, I guess you could even say I've had a slightly kind of antagonistic view. But at the same time, it's fair to say that regardless of how the dust settles on this, AI tools will be something that can make analytics better.
Mm-hmm. For sure.
Yeah, because I could certainly see, if nothing else, that if we can, use a tool to help us build models that I would have been days and days of me building myself. Well, shoot, that's better use of my time.
That's right.
As long as we maintain control over quality in it.
Well, yeah. I mean, you think about it. I mean, one of the fastest growing use cases for AI, ironically, is people developing their own personal tools, to manage their own, their own calendars or their own day-to-day lives. So, I mean, at the end of the day, it makes us all programmers, and that's beautiful. I mean, it really is. You think back, to what the microwave oven did to making, dinner time preparation much quicker, things, thawing out meat or whatever. But at the end of the day, I mean, AI's here. It's here to stay. Kind of reiterating what I said before. It's you can either embrace it or get out of the way and fade off to obsolescence.
Well, and we're going to come back to this as we talk about kind of the model risk, area, because obviously there's an impact there as well. But as I've said to others, man, it's an interesting time.
It is.
All right, great stuff. We're going to take a very quick commercial break. We'll be back in 60 seconds.
One of the most important questions you can ask about your enterprise risk management program is it helping you make better business decisions? Or is it simply taking up a lot of people's time without creating any value? Is it helping you gain a better understanding of your business? Or merely documenting what you already know? The tools and resources available from ERM Advantage are built specifically to help any organization get the most out of their risk management programs. We have the largest library of free content covering proven best practices in enterprise and operational risk management. We have developed industry-leading tools and templates for every aspect of the program, including risk appetite, risk assessments, risk monitoring and reporting, and so much more. All available at a fraction of the cost of developing these tools from scratch. We are ready to assist you with program development or enhancements, board or leadership training, or reviews of existing programs. Contact us today to see what best-of-breed risk management can look like in your organization.
Welcome back. You're talking with Brian Velligan, and we're talking about the analytic world, the modeling world, and we want to shift gears now and talk about the model risk management world, another area that I know you've done extensive work in. And having done so myself and you've sort of seen this evolve, I think it's an area where there is at least some guidance. We've got some structure, but I think institutions continue to struggle with some of the nuance, within the program. So I think it'll be helpful to talk this through. Why don't we just, again, start high level, general thoughts on kind of the state of, model risk management in the industry.
Right. Well, it's interesting because model risk management, I mean, like I mentioned earlier, I think as far as I know, that the model validation itself, a specific element of model risk management, is mentioned in 2000 in some OCC guidance, and then of course 2011 is actually when the federal regulatory agencies got together and created a real framework, and that was foundational. So you think about it. So MRM framework came out in 2011, in April 2011, and it probably took about a decade, for that really to come into full play. I mean, as everything, it was initially geared towards the larger institutions that the perception was they would have the resources to to implement those
Right,
types of
right.
tools, whereas smaller community-based institutions don't have the resources, i.e. the budget, to do that. But ironically, they're just as dependent on models. They may have fewer models in the inventory, but they're making the same decisions on models as well.
Right.
And it's interesting because the OCC and the Fed and the FDIC, the OCC and the Fed came out with guidance in 2011. The FDIC and the NCAA were privy to that and were informing to that guidance, but the FDIC didn't adopt it until 2017.
Yeah.
And in 2017, they actually put in a caveat that says this only applies to institutions that are $1 billion in total assets and bigger. And the irony is, I think they thought they were throwing shade to the smaller institutions that they supervise, but in reality, they quickly dragged the bar down. And this is what I saw was in 2017, 2018, 2019. I started getting calls from institutions that are under $1 billion, even institutions as little as say $250 million in total assets, needing a model validation. So, so they actually brought. So thank you, FDIC. You brought the bar down by actually setting that that floor. But but it was appropriate. I mean, at the end of the day, everybody needs to have some type of a critical challenge to the models that they're using, because I think what is different is when I think about my father. If he was doing math, he might break out his calculator and he might use the calculator and he might check his math and he might think about it. Does that number actually make sense? Whereas, people today, they just know the calculator's right, or they just assume the calculator's right.
Right.
And I think that's what's happening with models in general. I think back early in my career, I remember probably about 20 years ago, I went out to visit a small rural bank in central Pennsylvania, and the CEO was the grandson of the founder, and he was like, well, I don't really need an interest rate risk model because I intuitively know what the the duration, the mismatch between the repricing and maturities and all those kind of things, and he probably did know it pretty well. I don't doubt it. It was a very small institution. He knew his, they had 4 or 5 different products really, and it was very easily done. But now today, somebody may come in and just say, well, the model told me that, so it's got to be right.
Yeah, yeah.
So that's what's changed, I think, is our trust in the model output.
Yeah, and I appreciate things like SR 11.7 that again provides some structure, because again, I do a lot of work in general risk management. We have less as a guidance, so to say. There's some frameworks out there, and I don't like any of them. But at least in this one, I always thought SR 11.7 was fairly well thought out. It gave some fairly good structure. But what do you see is just some good, strong, general kind of model risk management best practices?
Well, I think best practices first and foremost are, and this will be a tip directly to SR 11.7, is the foundational concept of conceptual soundness. Does what's the business purpose of this model? So I think by answering that question, that even comes back to some of our earlier conversation about basically seeing an implementation of a model through to completion and not having it just sit on the shelf. So I mean, conceptual soundness is a great idea. I mean, honestly, it's all well thought out. I mean, I think back before 2011, we were doing independent reviews of models, and we used an MAP, an acronym, which is a model review, assumptions review, and a process review. And so I think it's pretty self-explanatory. We looked at the model itself, kind of conceptual soundness. We looked at the assumptions that were fed into the model, and then finally we looked at the overall process that governs the use of the model. And that framework was what we did before SR 11.7. Once SR 11.7 came out, we adopted their framework because the regulators are one of the few exceptions where plagiarism is a compliment. So we want to make the regulators understand very clearly that we are conforming to your guidance, and we're delivering a quality product from that context. So the idea that conceptual soundness, ongoing monitoring, outcomes analysis, and governance, bam, that's it.
Yeah.
I mean, you really key. To your point, I agree with you 100%, Eric, that I think this is some really well thought out and really useful and practical guidance. Yeah,
and in terms of kind of programs, any sort of typical shortcomings, either that could have led to a regulatory scrutiny or just in your mind, just not fully managing, model risk management. Any kind of common thin ice you've seen?
Interestingly enough, third-party external auditors and regulators alike really focus on governance. That seems to be which in some people, they'll say, well, we're doing this, but it's not in our policy, or it's not written, or it's not in our procedures. It's not written down. And that's great. We're glad you're doing it. And oftentimes we'll even say, although we observe this in practice, it's not actually codified in policy, which means you're doing it, and that's great, but it doesn't. But you don't have to do it. You know what I mean? So you can stop doing it. So we do see, ironically, regulators lean pretty heavily into documentation and governance. And if you think about it, at the end of the day, one of the main reasons why we have regulators is for especially because we have FDIC or NCUA insurance, and you don't want the insurance funds to be depleted. So the regulators are protecting, the depositors essentially at the end of the day.
Yeah. And there's a couple of different bits we'll sort of poke out a little bit. And again, some I would characterize as shortcomings. Some I think is just sort of figuring out what's the best way to do something. When it comes to validation, so once you've established that we've got X number of models that we need to have validated, in many cases they'll use external third parties for validations, and in some cases build that capability internally. Do you see a trend one way or the other, or is it really just a kind of a resource issue?
It really is a resource issue at the end of the day. I mean, it would be simplistic to say that big institutions have it more internally covered and smaller institutions outsource it more. I don't know if that's necessarily, well, I wouldn't say that's not true. I would say at the end of the day, it really depends, because, we work with some very large institutions that generally do model validation in-house, but they might have a specific type of model that they don't have that in-house expertise. And as such, they will outsource that. And then, obviously they have a governance process and an infrastructure, which we'll lean into, and we'll use their templates and their formats. But I think it really depends. It's resources. It comes down to resources.
Well, and one can argue, again, there's plenty of resources out there, yours included, to be able to outsource validations to. So, say, look, is this a priority to build the capability in-house? I think one thing I've seen that's the advantage is that you've got a captured resource. If we needed to do different versions of it or like that, you've got it. But again, of all the things we have to invest in and build teams for, is that a high priority, or is this something that, look, there's really good resources out there you could lean on for quite a while?
Well, obviously, one could say I'm biased, but I have to disclaim that. But at the end of the day, I think you're foolish to build it in-house, to be honest, because at the end of the day, by outsourcing it, you're bringing a higher level of critical challenge, because while the internal validator would be independent of the model owner, the person who's actually running and operating the model, at the end of the day, that independent entity may or may not have seen how maybe dozens or hundreds of institutions have done it.
Right.
So I think you bring a more robust critical challenge to the model, to the validation when you use a third party.
I think that makes a lot of sense, and maybe there's a hybrid that you sort of alluded to earlier. Maybe we have our researchers are doing stuff that's really kind of meat and potatoes, that isn't a super deep level of technical complexity, but for more, technical complex ones, utilize, as you said, an organization not only brings the skill set, but a certain amount of kind of peer review as well. How are you doing it versus how others are doing this?
Right.
And I think that makes a lot of sense. And there's certainly the question of is an outside party going to be willing to challenge more? I have seen instances where, you pick the model apart and you find there's some really screwy assumptions in this model and like plug numbers and I think the other thing too is just if somebody internally, are they going to be able to really call that stuff out and effectively challenge, okay, this number doesn't make a lot of sense. So let's assume you're going to be doing outsourcing validations. And again, you do a lot of these for different kinds of institutions. How do you get the most out of, having these validations done, particularly when working with a third party to do them?
Well, if I were in the other side of the table, if I were hiring a third party to validate a model, one of the first things I would look for is business acumen. It's not enough is the first question is this person a quant? Does this person have good analytical skills? The first question is does the firm do they demonstrate that they fundamentally understand the business purpose of the model? Because we saw that especially in the DFAST era, 2012, 13, 14, 15, that whole era, where there were a lot of very, very, very very smart people a lot smarter than me, quants coming in and building these crazy models and everything like that. And, but they never really understood what the business purpose of the various pieces that came together, like PPNR, pre-provision net revenue, and all these different elements. They didn't have the accounting background. They didn't have the banking background. And it was really interesting because at the end of the day, well, that's great. You got all these sophisticated people building these sophisticated models, but there's two failures. One is they don't fundamentally understand the business of banking itself, and two is they can't explain it to a board member who probably only has a 35,000-foot view of how this model works.
Yeah, and we've certainly seen, a kind of a flood of people coming out of nowhere and hanging up a shingle. We do validations, and I think you have to be able to really kick the tires and say, look, do they really understand what they're doing? One question that comes up, there's several actually here that come up fairly routinely, so I'm curious your thoughts. And one is, and I know there's no secret formula for this, but how much does the model change before you should really think about having it revalidated?
That's a tough question, and that really kind of starts to dip its toe into risk appetite, things like that. Because here's a question. So take an asset liability model. So if you're using the exact same asset liability model with the same core data, with the same team running the model for the last 5 or 6 years, well, do you really need to have the model validated? I mean, it's the same model, same thing. But over the last 5 years, what has changed and changed dramatically are the assumptions. Prepayment speeds have slowed, rates rose, and now they're creeping back down, and they may rise again later this year, depending on what happens with the economy. So so there's really it's not just it's the same model, wash, rinse, repeat. It's also like the external factors that may drive change in the model are those really being appropriately critically challenged. And ongoing performance monitoring can help address that. But if you don't have a good OMP or ongoing monitoring program in place that is run and administered by the first line, the people actually running the models, and you don't have the second line that can actually critically challenge the OMP, you've got a problem.
Yeah, and I appreciate this is a tricky question, and I've sort of taken the line that you can't just draw a line. If this changes, you have to revalidate. It's kind of case by case.
That's right.
And a discussion with the business about what did that change mean. Obviously, if it's wholesale changes, nobody's going to question that. But, I only changed like one formula. I think we could probably look at that in isolation, without having to do a full regression of the whole darn thing. Obviously, we've got SR 11.7 out there. Do you what have you seen, or do you anticipate any near-term changes to around expectations for model risk management?
I think eventually there'll probably be some type of guidance that will come out about AI models, and because there are some nuances in how you would validate an AI model versus a traditional model. So I think there'll be guidance around that. Now, some people may think about and say, "Hey, well, wait a minute, Brian. Regulators did come out with guidance around model risk management, I think in November of 2025, which basically said that it is okay and appropriate to right-size your MRM program to your institution size and complexity." Well, that's not a barn burner. I mean, that's nothing. It's they're just codifying, or they're explicitly stating what I think the industry has always believed. So it's not a get out of jail free card, or it's not any kind of we don't have to do this anymore. We don't have to do it as rigorously. It's just saying, it's okay. If we don't expect the same MRM program at a $200 billion institution that you would see at a $200 million institution.
Well, and I think your point about AI is great. I mean, I do hear that a lot, that there's a number of different settings in which it would be nice to have some guidance around what's expected. For institutions going through exams where they kick the tires on their program, are there any particular areas where they tend to be honing in? I realize that will differ by regulator, but in general, what are the things they tend to really look for in an exam?
In validation?
Yeah, well, and just in terms of looking at like a model risk program,
overall,
in like a safety and soundness exam, and Are they going to, what are they going to be looking for to show evidence of a program that's working?
Well, there's kind of like these 5 main factors. The first, of course, is policy and procedures. The second is a model inventory, and how that inventory is it, does it seem to be current? Does there seem to be a process in place where that inventory is challenging business lines? Because for better or worse, some model owners have kind of learned, well, it might be in my best interest to kind of keep this model quiet, because then I don't have to go through this whole MRM process, this whole model validation process. And unfortunately, that's one of the things that I think really needs to kind of change about thinking about, the purpose of MRM, because MRM is not really, I would caution first line and the C-suite to stop thinking of MRM as a regulatory function and to think of it as a value-added function.
Yeah.
Don't you want to know that the information that your CFO is presenting to your board or your chief compliance officer is presenting to your risk committee, that the data is accurate? So really, it really provides an opportunity to go into a model and just have a different set of eyes and say, hey, does this really make sense?
Yeah, and this is a question that I see that nearly turned into bar fights. Is it a model? So there's this perennial question looking at any given analytic tool. Is it a model? Is it an end user tool? And again, we're not going to solve this one perfectly, but any insights on how to think about whether deciding something is a model or whether it is really more just an end user tool?
Well, of course, as we know, SR 11.7 gave us some guidance on what is a model. But then you look at it, and I think it talks about an input component, an output component, and a processing component, and things like that. And then you ask yourself, well, does the anti-money laundering model actually fit that definition? And you could argue it doesn't. But yet, the regulators have made it clear, and the industry has backed that by showing that it is an expectation that your anti-money laundering model is inventoried and validated just like any other model. So I think at the end of the day, it really comes down to making sure that your inventory is complete and accurate. And it also making sure that you have good, policies and procedures. Because again, generally speaking, it seems like if your policy is wrong, you still have to do it. You don't have the authority to question. One doesn't have the authority to question the policy that's set by their board. So if the policy is wrong, you need to change the policy. So, so that's that's another key area in the program. And
I agree. In terms of like the BSA models, I think from my perspective, I think they just wanted it validated. So we came up with some tortured logic to call it a model. Fine, whatever. You want it validated, we'll validate it. That's fine. I think where things get tricky is, and can this be articulated in policy is, I've seen some spreadsheets that had all the defined criteria of a model, an input and output and formulae, but it really was just a tool being used by the business. So can this delineation really be defined quantitatively and in policy, or is it still a matter of we just kind of have to look at it and consider, is it like criticality? Is how much is depending on it? Is there as much subjective elements as objective criteria?
I appreciate the question because I realized I didn't really answer your prior question properly. So the simple answer in my mind is you will never be able to create a definition that will cover everything that could possibly be a model. At the end of the day, it's really a question of like, what happens if this element, we won't call it a tool because I don't want that confused with an end user tool, this element, whether it's a spreadsheet, a model, an end user tool, whatever, this thing that I'm using, if it's wrong, how bad is it?
Yeah.
And if the answer is like, oh, I got one lending customer where, we charge them too much or too little, for their monthly loan payment, that's not that big of a deal. But it's like if I'm going to lose earnings, if I'm going to lose capital, if my reputation's going to take a hit, or I'm going to get a big fat fine from the regulators or get an MOU, that's the driving thing. So I think at the end of the day, really the answer is, how bad is it for us as an institution if we get it wrong?
Yeah, and I'm a big fan of keep it simple, stupid. So one of the ways I've seen, I think, trying to stay away from the bar fight about how dare you call this a model is, at minimum, we can tier things. Mm-hmm. This is a tier 1. That's easy to figure out. And then, based on a tier structure, that could translate to the amount of rigor around it. It's something that's a tier 3 or tier 4. maybe we kick the tires on it every 3 or 4 years, or maybe we
Right,
just do
right.
a peer review as opposed to a validation. So you could align some of the governing approaches to them based on that tiering, which is going to consider criticality of the business and influence and impact, like say if it's wrong, that sort of thing. And I've always kind of taken an approach of, look, we don't have to be precise about this. I think this can be a conversation. I think the important part is, are we kicking the tires on the really important ones?
That's right.
That we are, in fact, making business decisions from. Favorite topic of mine, documentation. And I always say favorite because no one ever has enough. They always need more. But in this context, I think it serves two important purposes. One, make sure if you leave, somebody else can have a fighting chance of understanding what this dumb thing is doing.
Right.
And I think there's an optimization element. If I'm going to use somebody like a third party to do validation, doesn't that make your life a little easier if you've got some decent documentation to work off of? So it'd be fair in saying that you probably need more and make this a priority. Make sure your models are properly documented.
Yeah, that's a great point. I mean, there's two key forms of documentation that come top of mind. One is what we commonly refer to in the industry as model development documentation, and that really answers the conceptual soundness question. Why did the institution invest real dollars, resources, and effort into this software tool? So that's your model development documentation. It also tells you how the model was developed, how it was trained, how it was set up, and everything like that. And then, of course, you got the procedural documentation. To your point, Eric, that's when your employee wins the lottery and just disappears.
Right.
And,
right.
So it's kind of like, okay, now can somebody come in behind the scenes and rerun this thing? And that also really, if you've got good procedures documentation, that helps the validator be able to step through the modeling process, which means they're not bothering your first line as much with questions.
Right. Yeah, a very wise colleague many years ago said this. I've never forgotten it. Good documentation makes an organization self-healing. And that's spot on.
That is spot on.
Because, somebody leaves. Well, how do you run this? I don't know.
Mm-hmm. And it happens more than you think. I mean, I can't tell you how many times we got the panic phone call from somebody who said, their AL manager or the BSA officer, I mean, unfortunately, a lot of times they get sick, and it's usually something like that when somebody has to leave abruptly, or they've been in an accident or something like that. And can you come in and can you run this thing for an indeterminate amount of time?
Yeah.
And I can tell you right now, the cost of engagement is directly proportional to the quality and quantity of the documentation provided.
Yeah. And at minimum, all the things you mentioned, what's the purposes? How does it work? How do you do all this? You've known me for a long time. You know that I'm constantly going on about assumptions. Risk always lies in the assumptions. And you also encourage, and if you're building documentation, is use that as a platform to also capture core assumptions that are part of this model so that people know to challenge those assumptions.
Right.
And I never see enough of that. And I'm always surprised because to me this just seems stupid smart, like I say. So you're limiting ambiguity, which in the risk management world is always a good thing. And once again, we're back to the dreaded topic of AI. So AI is in this context a bit of a blessing and a curse. We're seeing some interesting use cases, and certainly could chat about some of the use cases you're seeing, but it antagonizes things like validation because, again, we can't see fully inside the box of what it's doing. So I think it's going to be challenges there. But at the same time, I could see it being a tool to help us do better validation. So just talk broadly about how you see AI impacting the model risk management world.
Well, sure. I mean, the AI, is providing us in my industry with an opportunity to maybe automate, for lack of a better word, some of the more mundane tasks of model validation. Now, we have to be careful because obviously a lot of the models that we touch are privileged and confidential. So you got to make sure you understand are using AI that's properly sandboxed. So that way this information isn't getting out into the wild. But that being said, it's like everything. I mean, it makes us as practitioners be able to work smarter, and then we can focus on things that really matter. Because to your point earlier about assumptions, Eric, I mean, honestly, you can make a model say whatever you want it to say if you know how to tweak the assumptions.
Yeah. Well, and if an institution is using a third-party analytic tool, and it's got like a XG Boost or something inside where there's an AI component.
Right.
Again, I can't necessarily unpack it, but when you're thinking about validation, what are the kind of things you're looking at? Does that include how the model was trained? Does it include, the type of model it is, any kind of analytics? I mean, how do you get comfort level from the vendor that this model isn't giving you garbage results or biased results?
Well, that's the million-dollar question right there, Eric. I mean, it's really challenging because a lot of vendors will stand behind, well, I can't answer those questions because that's proprietary.
Yeah.
They will vigorously protect their IP to the point where it'll stymie a quality validation oftentimes. And second of all, and this is the dirty little secret, is I don't know if all the vendors even fully know, exactly how how the models are working. And but leaning into the first one, the first answer is the official answer. That's proprietary. So you run into two challenges. One challenge is can you get more information on how the model was trained? And that's actually, I think, if the U.S. follows the EU and comes out with some type of AI-specific model validation guidance, it'll probably lean into that and kind of what I would consider in the conceptual soundness area.
Right.
In that is that you're going to do a deeper dive as a validator in how the model was trained to do what it does. Because I mean, honestly, you can pick up any history book, anything. When you think about it, models are trained on historical data, which probably means that at some level, some way, some shape or form, there's some kind of bias in there, whether it's gender bias, racial bias, whatever. You're going to see that. So you're going to have to understand how that. You're going to have to understand how that works. Now, the other challenge is, especially like with the credit decisioning model, is then you get into the situation where is the model, how do we understand, how do we understand credit denials? Because there's a SR 11.7 component to that. But there's also a fair lending component to that, and they kind of, like a Venn diagram, they kind of come together a little bit. There's a little overlap between those two spaces, and so. And those things are really, really critical. And the regulators have made it very, very clear that you don't get a free pass as an institution and saying, well, it's an AI model, so you don't get any fair lending pass on that.
That's the really question is, do the regulators even know how to regulate and examine this stuff? Because they're still learning it too.
Well, and I'll go a step further, and that is that there are a lot of AI models out there that aren't really using AI or ML. I mean, it's the buzzword, It's like, I think about it, it's kind of funny. About 4 or 5 years ago, I started going, I go to conferences every year, and, they started having an AI track. They were specifically talking about AI. And then they started talking, and then more recently, they started talking about quantum computing and what that may look like. Now they're talking about AI in quantum computing. So it's like, wow, it's really getting kind of crazy out there. And, we don't even understand quantum physics, so how could we possibly understand how quantum computing really works? But at the end of the day, it's going to be a challenge, and I think this gets back to our earlier part of the conversation today, where we were talking about AI, our interaction with and our reliance upon AI is moving at a pace that is unmatched by anything we've ever experienced in the past. Well,
and at some level, I'll admit this is a little bit unfair because the sands are shifting. Obviously, as you said, this is evolving very quickly, and our use cases are still being sort of worked out. And it's going to take several years for us to really settle in as part of business as usual. So, all these questions are semi-informed speculation. But we've been around on this rock long enough to have some instinct. But the sense I get is this is a healthy combination of will bring some really interesting capabilities, but some challenges and stuff we're going to have to figure out how to work with. And so we're going to have you back because I mentioned earlier that Brian's one of the principals of ABC, and they've just completed a strategic merger. And so he's going to have a lot more information coming up on some really interesting capabilities coming. And so we'll have you back to talk more about that. But Brian, thanks so much for being here today. I really appreciate it.
Well, thank you, Eric. It was an honor and a privilege, and I'm already looking forward to coming back, so can't wait for that.
All right. All right. Thanks for listening.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage, LLC. All rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.